The first intragroup transaction we will focus on is intragroup dividends. But before we discuss the effect that intragroup dividends would have on the consolidation process, it is important to understand a few general principles regarding dividends. Dividends are addressed in the following standards. We do have some guidance in IAS 1 with regards to presentation of dividends, in IAS 10, events after the reporting period, and also in IAS 37, provisions, contingent liabilities, and contingent assets, which you would look at later on during this year. Before we can consolidate, it is important that all the necessary entries with regards to dividends have been accounted for in the separate financial statements before the consolidation process begins. Remember, my starting point is the separate financial statements of the parent and the subsidiary. So all these dividend transactions and the effect thereof would first have been accounted for in the separate financial statements before we can consolidate and eliminate the effect thereof. There are 3 important dates regarding dividends, and each of these dates have different accounting consequences. We will now look at each of the 3 dates to understand what happens at each of these dates in the separate financial statements of the parent and subsidiary. The first date is the dividends proposed date. On this date, a possible dividend declaration is proposed by the directors of a company. This dividend has not yet been approved, and there is no present obligation on the entity to pay this dividend. This dividend is not yet accounted for and is therefore not presented in the statement of changes in equity as a distribution of retained earnings. This proposed dividend is, however, disclosed in a dividends proposed note to the annual financial statements, where the total amount as well as the amount per share are disclosed. But on this date, nothing has been recorded by either the parent or the subsidiary. So if the subsidiary only proposed a dividend, there will be no transactions recorded in either the parent or the subsidiary with regards to this dividend yet, and therefore there will also not be anything to eliminate as part of the consolidation process. The second date is the dividends declaration date, the date on which the company declares the dividend. On this date, the dividends are approved by the shareholders, and once the dividends have been approved, the entity has a present obligation to pay this dividend. And the moment you have a present obligation to pay something, there's a liability that has to be recognized. This is also the date when the dividends are recognized initially by means of the following journal entry. Now, in a group situation, the intragroup dividend would relate to the dividend declared by the subsidiary. Because the parent is an equity participant of the subsidiary, the parent will receive some of the dividend declared by the subsidiary. Any dividends declared by the parent will be declared to the owners of the parent, and they are parties outside the group. A dividend declared by a parent will not be an intragroup transaction. So this transaction, when the dividend is initially recognized, happens in the separate financial statements of the subsidiary. Debit dividends declared in the statement of changes in equity, and credit shareholders for dividends as a liability. The dividend declared will be presented as a reduction in the retained earnings column of the statement of changes in equity as a reduction of retained earnings. And you will also disclose a dividends per share amount at the bottom of this statement. This shareholders for dividends represents a current liability and will be presented in the statement of financial position of S. So this is the transaction that S would recognize in its separate financial statements which would be your starting point for the consolidated numbers. The date on which the dividend declared is usually also the date on which the shareholders can recognize the dividend receivable. Now, in a group situation, if the subsidiary declared the dividend, the parent is the shareholder, which can now recognize the dividend receivable through this journal entry. And this bottom journal entry would be the one that the parent would recognize in its separate financial statements. There would be a receivable, dividends receivable, and in profit or loss, the parent will now already recognize dividend income as part of other income in this blockie. The dividends receivable will be presented as a current asset in the statement of financial position. The date on which the dividends are paid represents the date on which actual cash flow occurs, and the current liability in respect of shareholders for dividends is settled. The entity paying the dividend will process the following journal. And as we've mentioned, in a group situation, talking about intragroup transactions, the entity paying the dividend will be the subsidiary, recognizing this journal entry in its separate financial statements. Debit the liability shareholders for dividends that will now be settled, and credit bank. The entity that has the right to receive the dividend, which is the parent in this scenario, will process the following journal in its separate financial statements. Debit bank with the monies received, and credit the receivable, dividends receivable. It is important to remember that all these journal entries first have to be accounted for in the separate financial statements of the parent and the subsidiary before we can commence with the consolidation process. So when we now commence with the consolidation procedures and the consolidation journal entries, we assume that all of the necessary journal entries have indeed been processed in the separate financial statements of the parent and the subsidiary, depending on whether the dividend has been declared and or paid.